Last week, there was a small error in this backtesting matrix. In the alpha, what I've done is we had P6 here. Actually, it should be M6. So just that small correction. I'll upload the sheet. There is no slide deck as such, just like step by step way to write the screeners or some factor investing. You might also pick up a little Excel organization skills. And if you have a better way to do this, you can let me know. In the NSE, there is a file called resources, historical data. Archives of daily and monthly reports. In this, you have something called market capitalization, weightage, beta, and all those factors. This is a month-end data product. I mean, it doesn't get updated every day. So yes, you have to put month-end. That would be July last working day. If you put any other date, you won't get it. They're just giving, but it is, you won't get it. I will tell again the location. So NSE India, resources, historical reports. At the down, archives of daily and monthly reports. This, the market cap. This file has 4 or 5 factors or the data points. One is the current Nifty constituents. And so this is an important point that you need to remember whenever you're doing any backtest. So if you go back to 2008, you should know the 2008 Nifty 50 components. So you will get the data here. up to 2008. Security, industry, equity capitalization, free float, and weightage. So weightage is basically for a Nifty 100 percentage, your Adani Ports has a weightage of 0.73. This is a free float weightage. And then the topmost is Reliance, as of now, which has 11.5%. If you add all of them, you should get 100. Yeah, so 99.97. And then you have a beta. This is the beta against Nifty. Beta is simply by how much the underlying security moves when the benchmark moves. So 1.41 means if Nifty moves by 1%, your Adani Ports moves by 1.41%, either way. If Nifty is down, Adani Ports will be down by 1.41%. That is a characteristic in the last 1 year. And then you have R2. R2 is the correlation square. It is simply how much percentage you can explain. So Adani Ports is 0.53. That means 53% of the times Adani Ports and Nifty move together. If you just let's say plot Nifty returns and Adani Port returns,
Gaurav, there's a black bar at the end of the screen, bottom center.
this one, right? Where my cursor is.
Yeah.
Yeah, that's a ribbon. I can't avoid it.
Okay.
Say if you get return something like this, to put a dot. Something like this, and then you will draw a connecting line of all the data points. Obviously, you can't draw. You can draw best possible way, something like this. So in this, you have 7 data points. And let's say 10, 8, 9, and 10. So the 5 data points are connected to that line. So that means 50% of the times you can explain what is the Nifty and Adani Ports relationship. The rest of the times you cannot explain because they are somewhere outside the connecting line. And, this is simply correlation square. Then you have a volatility. The way that NFI guys calculate volatility is by a log method. Suppose we have a daily returns. something like this. BSC it is market data products and market data. So we have all the data here. Equity historical prices. Adani Ports. Daily data. This file would have calculated on 1st August 2021 to 29th July 22. We'll delete this and we'll come back to 1st August. This is your close prices. You simply take log change, natural log, ln this divided by this. And just standard deviation of this whole series. And it's daily, so to convert into weekly, you have to take square root of 252 or 250. There are 249 data points. Guys, I mean, sorry, you have to mute yourself.
సండే నాకు చాలా హెక్టిక్గా ఉంటుంది, ఆఫీసెస్ ఖాళీగా ఉంటుంది. లైఫ్ దగ్గరగా బాగానే మెయింటైన్ చేస్తారు, తక్కువ వస్తారు. అంటే క్లబ్ మెయింటెనెన్స్ కట్టారు కదా.
Who is this? I mean, it's a standard deviation of daily returns. Yes. So how we are getting it? So let's see. I'm getting 33%, whereas he's getting 90. I'm not sure where I'm going wrong, but this is the close price and long change and standard deviation. So I'm getting 33, whereas he's getting 90%. Let me come back to you how he is doing it and where I gone wrong. So that's your volatility. And monthly returns, we are not interested. But we do have the data. And then you have this impact cost. What is impact cost? What is impact cost?
Spread between buying and selling, buyer and seller, bids and ask price.
It's almost correct, but thing is, this is a value for a 50 lakhs. So now 50 lakhs means you have to buy 10,000 worth of Asian paints. $10,000, right? Yeah. 10% is 50,000. So 2% is 10,000. For 10,000, you might get 3 Asian paint stocks. Now, if you have to buy those 3 Asian paint stocks, you will be paying 0.02% extra. That's a bid and ask spread. I mean, if you hit the market order, you will pay 0.02% than the current market price of Asian paints. This whole value for Nifty is about 0.02%. The big stocks, price-wise, like Shree Cements, so they are at little higher spread. I don't know why Tata Steel is at 0.03. Now, what I've done is, I've taken the data from 2008 because that's last date that it goes. So it goes back up to January 2008. In fact, not 2007. I've taken January 2008 data as December 2007. So it's a small mistake. I wanted to do this because January 2008 was a big down month. So if you are doing any backtest, you might as well include the bad data. Like market went down almost 15-20% in January 2008. Then what you have to do is this is the 2007 price, December 2007. Entry is, we assume that we enter at last trading day of the year. And exit is next year. And this is your P&L. It is simply E into E minus D percentage wise. Now you have some factor. It's called split or bonus. Split adjustment is simply either you will reduce the entry price or you jack up the exit price. But again, you can't jack up the exit price. So you will reduce the entry price. If it is 1:1 split, if it is 543, you will reduce it to half. Then bonus is A:B ratio. The adjustment for bonus is what is the adjustment factor for bonus? If bonus ratio is A:B. This is the one, A plus B by B. That's the adjustment factor. If A:B is the ratio. So 1:1, you don't have a problem. 1:2, that's where you have a problem. So 1:2 means for every 2 shares you have, you will get 1 share. So 1 plus 2 by 2. So that is 1.5 is the bonus adjustment factor. In which case, you will reduce this entry price by 1.5 times. So I've just written some small formula. If it is so and so, adjusted by that particular factor. And that is bonus and split. You have dividend. So dividend also needs to be adjusted by a percentage wise. So suppose a stock which is trading at 100 has given you a dividend of 5 rupees. That means your 100 becomes 5% less because 5 rupees is the dividend. So you will adjust it to 95. The previous value, let's say it is 99. So you will adjust it by a factor of 99 into 5% reduction. That would become your close. I'm not doing dividend adjustments in this file because of 2 reasons. One is anyway we have to pay a slippage when we are buying and selling, and also a little bit of brokerage, STT and all those things. So I consider dividend as cost of doing the business, like buying and selling the shares. Ideally, you should do if it's a very high dividend paying stock. But there are very few high dividend paying stocks in NSE, except Coal India and NTPC. The rest of them all pay peanuts, like 1% or something like that. So you can ignore it. Then there is a tricky adjustment. What is that? What is the other corporate action apart from bonus, split, and dividend?
Merges.
Right.
Rights issue.
Rights is one, but they're very rare. So I'm not considering rights as adjustment here.
Buyback.
Buyback, it doesn't affect anything. It just affects the price. But you don't need to do any adjustment.
Yeah.
I have highlighted Bajaj Auto there for a reason. So that's a hint for you. the demerger or creating new companies out of the existing companies. That's the biggest adjustment that you need to be aware of. So Bajaj Auto has split into 3 companies in 2008. Bajaj Finance and Bajaj Finserv and Bajaj Auto. Or Bajaj Holdings. No. Bajaj Auto, Bajaj Finance, Bajaj Finserv. So when you take the Bajaj Auto year-end price, it will be something else, and you would have got one Bajaj Finance stock and Bajaj Finance stock. So you have to add all of them and adjust the price accordingly. So what I would have done here is wherever this Bajaj Auto is there in 2008, that price I would have taken as a add one more Bajaj Finance share and Bajaj Finserv share and arrive at the final price. This is a lot of difference if you don't consider that. And the another company which has done extremely well is apart from Bajaj, what is the other company which has done extremely well by demergers or spin-offs? Come on, make a guess.
Adani.
Yeah, so Adani Enterprises or Adani Ports has done quite a few demergers. So it doesn't appear in Nifty 50 those days. It was a junior Nifty or next 50 stock. It has done quite a few spin-offs or new company creation. Right, so all that I'm doing here is using the VLOOKUP to get the price of each year end, and again the exit is again a VLOOKUP and then the difference. So this is your price data, right? So let's get for 31st December 22. That means it's today's price. Here, right? So here I will get the data and put it. I'll just tell you something different if you are not aware. You can either get it from here, the market data and indices. Just download the Nifty total market cap and then do a VLOOKUP. VLOOKUP of this in this one. So that's 6. Any unusual Tata Steel is unusual. So the split factor here is 10. Wipro is down this much, or the split?
No, it's down at this much.
It's down almost 40%. So we have the latest price data. Now what I've done is I've taken the file, this particular file, at each year end. So I'm considering December as year end. Yes. I operate in US financial year, which is Jan to Jan or Jan to December. You can do it in whatever the way you are comfortable, either March to March or December to December. So I've taken each December file and put it here. So the same security name, industry equity weight is beta R2 and R square and volatility. So this file you have all the way up to December 21. So if December 22 comes, I will again put it. I would be giving you this OneDrive access. So whenever I do a session, you have a latest data. You can get the latest data from there. Now just get this particular price data. And just update it here. You have the factors here, right? So now what I'm doing is I want to get that particular factor of I2. I2 is ABB and this particular date. Concatenate date slash hyphen and B2. So this is the same thing I would have used here. Date, concatenate and the symbol. So 39447 hyphen ABB is what it looks in the VLOOKUP. Right, and then of this in V2 AF. It goes all the way to AF. So where is market cap? 1, 2, 3, 4, 5, 6, 7. So this is 7th place. Or actually weight is 8. Both of them are same. Free float market cap and the weight, corresponding weight in Nifty. So we'll drag it across the board. So we have all the market cap for each year end for each stock which was there in Nifty 50 at that time. You can see in 2007 you had Kane. The company is gone. It's merged into Vedanta, right? Kane Energy. You had Glaxo at that time. It is no more. You also had Idea, which is not anymore in Nifty index. You have RCOM and RPL, which was again merged. Then Satyam Computer, this company got bankrupt. So this is what I was telling. Like you have to do the backtest point in time or considering on that particular positive data. Now what I have to do is I have to arrange each year wise top and bottom market cap. So I'm doing a sort. My data as headers, entry, that is your date. So all the dates at one go, and market cap, largest to smallest. So Reliance is the top market cap company in 2007. Now again 2008, because you have done a multi-sort, something else would have come. So it's again Reliance. Now what I've done here is if H2, that is the year, is the same, you keep adding. So Reliance is number 1, ONGC is number 2, Bharti is 3, 4, like that you will get. And as the year changes, you will reset to again 1. So your market cap rank of a particular company is taken care of. This is in top to bottom. And I've also written a reverse formula where the bottommost company will be 1. Right? Here it is. If the year is not the same, write as 1 and keep adding below. So Reliance is top market cap. And if you go from small to large, Reliance will be 50th company because the smallest company will have a rank of 1. Now we have the returns here. All right. So just take the average. So that's some 52.16. That's what you can do. That's exactly is what my formula here. Average if less than or equal to 10 companies, top 10 market companies, and do an average on F, which is the P&L or the profit or loss for that particular stock for that particular year. And you also do the bottom. Each year, top and bottom market cap. And this is Nifty. I have manually plugged in. So what is the Nifty value now? $16,559. 17,559. Now the next thing is if I put 100 at the start of 2007. So 2007 means these are returns actually for 2008 year. Like 2007 end you were investing. So you have to read it as 2008 returns. So in which case 2021 means it is the returns for 2022. So if you had invested in top 10 market companies at the start of this year, you would have got 4.7% in top 10 stocks. Top 10 market cap, and bottom 10 you would have got 6.8. And this is 100 because you lost 52%, you are getting 48% at the end of 2008. The same 47 is what you will invest. So you gain 60%. So it gone to 77. You keep doing this when you are not putting any additional money. So as of today, you had 352 rupees by investing in top 10 market companies. If you had invested in bottom 10, you would have had 283. If you had invested in Nifty, you would have had 286. What does this figure and this figure tell you?
It's better to invest in the top 10.
Yeah, so a lot
Market
of guys
cap
keep
control.
telling it's manipulated, it's not all the stocks are participating, so this rally is fake. That kind of statements you would be hearing, right? You will be hearing, right? This is not all the stocks are participating. So it's only a few stocks of index or index management or something like that.
Bora, could we increase the CAGR by doing a monthly rebalancing?
No, it's costly affair.
This is that on expiries they manage the index and everything. Like
Some statements like that you keep hearing, right? But that's
yeah,
not true. What do you see by the data? Boss, it's always the top 10 stocks which moves the Nifty. The rest 40 don't care. I mean, they move, but they don't add any value to the index. That's what is evident from our calculations. And then you have average and standard deviation. Average and standard deviation. So the bottom stocks, they're highly volatile, as you can see. The top 10 stocks are least volatile. In fact, lesser than Nifty on a yearly basis. This is just a statistical two-tailed t-test and a p-value for that. You won't get statistically significant p-value because you have very less data points. And this is the average and the standard deviation and the beta. So whoever attended the last week's class, you can relate with the beta and alpha and R square and Sharpe ratio. The R square is 100 almost. It is true because your top 10 stocks is what moves the Nifty. Would I invest in this model? Yes, because there is a little bit of alpha. But I won't invest because the R square is almost 100. I might as well buy Nifty. But the point here is the top 10 stocks, top 10 market stocks outperform the bottom 10 market cap stocks by 352 to 283. And it outperforms Nifty as well.
just a clarification. The top 10 market capitalization stocks, not the free float or anything like that. It is the top 10 market. So we got Reliance, ONGC, Bharti Airtel. That is in 2007, of course.
Yeah, so free float is a market cap top weightage.
Okay.
Wipro is one example. I don't know the market cap in 2007, But in 2000 and 2001 times, Wipro was almost the top one market company. Almost, I don't remember. You could have seen the headlines. Something like Hashim Premji is the richest man in the world or something like that. Or like second richest when Wipro stock went through the roof. But the free float for Wipro stock those days was hardly like 10%. Now, because our index methodology is free float, if Wipro would be somewhere down, not the number one stock, even though it is the overall market capitalization is almost number one. This was in 2000. The case for now would be Coal India. So Coal India is entirely held by government. So total market cap is about 141, right?
Just doing it. It's NTPC to show.
Right. So Coal India rank is almost bottom, right? 44. Now, if you take, let's say, this stock, Hindalco. See, Hindalco total market cap is way less than Coal India. But still, Hindalco has higher weightage. That's because it has a higher free float. Right. So Hindalco is 34 versus Coal India at 47. I think, yeah, you got the answer, whoever asked that question.
Yeah, so right now on July, this July file, that 2022.
Yeah.
So the top 10 market cap companies.
On Alliance, HDFC Bank, ICICI. There won't be any HDFC. So that will come into one.
We have to sort by equity capital, right? That E column.
Weightage or free float.
Oh, okay.
Weightage and free float are the same.
Okay.
They correspond. Now, what you can do is you can keep repeating this exercise for all the factors, right? After market cap, what is the next factor? Beta. Beta is 9. Sort by largest to smallest. So whatever doing is investing only in top 10 beta companies or bottom 10 beta companies. Each year, you keep repeating that. You can see a a very big revelation here. What is that?
High beta won't give returns. I like,
They
I
haven't
mean,
made any
very,
money
very
last
less
year.
returns. Almost half the returns.
Not all the returns. They haven't made any money. Just because 2020 you got some money, your 100 has become 146. Otherwise, it was always 100.
Hmm.
I mean, if you remove this fluke here,
Yeah.
just put some 10%. You are struggling to make get back your money, right?
Yeah.
146. There's also a startling revolution here. If you invest in bottom 10 beta companies, your money is 620 now versus 286 in Nifty. So that's almost more than double the returns.
That's
Just
amazing.
buy a low beta stock and sit on them.
Yeah,
They'll make
amazing.
Unfortunately, this year it is down by 4%, whereas top 10 were up by 5%.
Hmm.
Nifty is up by 1%. So you are underperforming by 4%. Last year also you underperformed. Last before year we massively outperformed. So the outperformance is not consistent. It comes in a bouts.
What is the maximum drawdown? Can we check for this bottom 10 beta?
You can't check. It's
Okay.
on a yearly figure.
Yes, yes.
The drawdown on a yearly wise is only two. Actually, only this year you lost.
2008.
You lost. These are not big losses. This is kind of a buy and forget.
Yes.
You have hardly any losing years in low beta. So even in 2008, when the world is collapsing, you lost only 20%. And the rest of the losses you can write off. Not big. Nobody will question you because you were just losing 4% in 2011 and 2016 another 5%. This year 4%, and it will make up in dividend. So this year, what are the bottom 10? These are all high-paying dividend stocks, especially. Hindustan Lever pays 2% dividend. NTPC pays quite a bit of dividend. Britannia is a 2% dividend stock. Nestle is another 1 to 2%. Power Grid pays a lot of dividend. Any government company has to pay a lot of dividend. Whereas here, I don't think these are any dividend paying companies. Yeah, the point I'm telling is these 2 years are not loss making years. They are like flat. You add 2% dividend, you are close to flat.
I think the underperformance is due to inflation. Most of these are FMCG stocks.
Just a random observation.
Hmm.
Maybe I don't know. You can link anyway, but I'm just looking at just the factor called beta.
Mhm.
I'm not dwelling much into
Yeah.
any grouping of them.
Mhm.
Right, and then you have after beta the R square, right? Yeah, so right R square and this will become 10. And you do a quick sort. The same story, the highly correlated companies with the Nifty won't give you any returns. Versus the low carol companies are at 430. Your 100 has become 430 by massively outperforming Nifty, which is at 286, versus top correlated stocks which are only 140. If you remove 220 in 2021, you are barely breaking even. Your 100 is there only, stagnant. Then do for volatility. Same story. Your 100 is 100. If you invest in top highly volatile companies versus low volatile companies where you are outperforming Nifty by small margin, 353 versus 286. So what's the lesson here?
Return comes from stable stocks.
To summarize, this is what and highly correlated with Nifty. Right? I will put that. Actually, you can do this also. Stay away from small cap stocks.
You mean small market cap stocks, right?
Within Nifty basket.
Within the Nifty. Within the Nifty.
Yeah. Because they haven't returned much, right? I mean, there's a slight difference, not much like high beta or high volatile or high correlated. That's why I put this point on 4. High beta, there is a lot of contrast, 600 versus 140. High volatile is this one, 350 versus 104. And high correlation with low correlation is actually a lot of difference like this. So this is the order. This is 600. This is some number which you can paste here. Just as exercise, I haven't updated, so this is what it is. Up to 2021, I haven't included 22. This is the market cap factor, 384 versus 232. This is beta, 150 versus 620. This is R square, 140 versus 418. And this is volatile, 100 versus 371. So the top performing factor is low beta at 620. Next is low R square at 418. Then low volatile. Then top market cap. So the lesson is this: if you are ever trying to pick the stocks, get away from those four factors. When I first done this exercise in 2016, I've read a lot of literature, but I was shocked by this, the beta factor. And also to certain extent, this correlation. Somewhere here I would have done this particular study.
I mean,
Uh,
the low correlation thing, uh, I mean, low beta one can understand the rationale behind the outperformance, but low correlation is it is difficult to put a finger on why is it doing this.
That's what Dario preaches. Pull up an uncorrelated strategies, you will outperform. That's what exactly is happening. So pull out 10 low correlated Nifty stocks, you will outperform it. This is a good outperformance, not bad. So 10.71 versus 8% of Nifty returns. In the two portfolio allocation, if you are a long short guy, you can pick and choose the any one factor versus the other factor which is not performing, and get something like this. So this is just a fun part. Where is it? This is the one point. This because I'm peeping into the data, so I'm picking up. Okay, so I'll just pick up the bottom beta. And high volatile. I'm shorting them, so my returns would be -1 into this. What it says is the optimized equation is 75% of long top 10 beta and short 24%. If you have done that, I don't know what is the control here. The point here is you won't lose much in any year because you have a short component in the top 10. And sometimes you lose big also because a violent recovery happened in 2009. So you were shorting 25% of this. So you lost a bit here. But the thing is, you will do a little bit of consistently. Your returns will always be in this particular band. I won't suggest this model, but you can. I mean, if you are thinking of doing a long short model, you can do this. So
Also, this could be great for these SSO guys, these single stock guys, like who sell options.
more than options, yes, you can do on features.
Yeah, features also. Yeah.
The standard deviation of this portfolio should be very low. Just 12%. And your average is also 10%. Versus your Nifty, which is the benchmark, right? So Nifty standard deviation is 28%, and the average returns are 12%. Here, your model returns are average is a little bit less, versus standard deviation is less than off. Of course, we did a little bit of peeping Tom business. I mean, I picked the best from the best performing factor, and I also picked up the worst performing factor. They might change in future, so this is not valid. But anybody who wants to explore long short model can pick and do this particular stuff. I'm also not a big fan of monthly rebalancing in this particular model. Yes, you might get a little extra returns, but there will be a lot of transaction costs involved in it. If you do either quarterly or monthly or half yearly or annual rebalancing, whatever these numbers are, right? It's 353 versus 104 versus 286. Yes, you might improve this to maybe 400, but that's not worth because you are paying tax and transaction costs. If you do a yearly rebalancing, you pay very little tax because you still have the same companies. At least 50% of the companies you will keep it. And these rankings won't change so fast, right? Suppose if I am doing a low beta model, right? Low beta is 7, 8, 9. So this many transactions, 300, sorry, 15 years, so 150 transactions, out of which you are basically rotating within those 36 stocks, not 150 transactions. So, in fact, if you have looked at 2021 to 2020, your ITC is there. Okay, ITC is gone this year. Hindustan Lever is same. Then Nestle is there. Divi's is there. Cipla is there. You just change the Coal India to HDFC Life and Wipro to TCS. ITC replaced with maybe Asian Paint, something like that. And Power Grid with maybe Britannia. Yeah, but so your churn here is only about 3 to 4 companies. And if ITC has given some profits, yes, you are booking at a 10% tax rate and entering into HDFC Life. Hindustan Lever, yes, if it has given like 10% returns, you might shift it back to 10%. So you sell 0.1% or 1% of Hindustan Lever portfolio and then get into something. So your transaction cost and tax cost is very less. To do yearly rebalance. If you are doing this on monthly level, so this is 15 years data. So instead of 150, you will have 15 into 12 into 10. That's about 1800 transactions. And I'm sure this list would have been not 36, maybe 300. Maybe 200. Right. Any questions so far? I will just take about 10 minutes break. If you don't have a questions, I will mute myself. And I'll come back after 10 minutes. All right. What we are doing so far is equal weight. So we start with 100. If it becomes 70, then we'll invest 70. That is 7 rupees each in stock. And if it becomes 182, we'll reinvest 18 rupees per stock. What I'm trying to do now is experiment with various other weightage mechanisms apart from equal weight. What we are taking here is we will just take the top 10 market cap companies. You can experiment with whatever you want, but let's just take the top 10 market cap stocks. Market cap is 8 or 7. 8. So you have all these 4 factors pulled out from VLOOKUP for each year: beta, weightage, R2, and volatility. Suppose we have 4 stocks. This is our portfolio. Equal weightage means how much we allocate each?
25.
25%.
So now let's say there is a factor, some factor, which is market cap or volatility or anything. In the value for that factor for A is 1, 2, 3, 4. Now, if I have to do as per factor weight, that would be this into 100 divided by sum of all the factors. So I'll get 10% weightage. For the second stock, 20%, 30, and 40. I also can do an inversion factor. What do I mean by inversion? So I will just reverse it. So the bottom factor will get top weight and the high factor one will get lower weight. So in this case, the stock stock A gets 48% versus stock B, which is 12%. If you have gone by factor weight, this would have got 40%, and this is 10%. So you reverse it. So that's inverse factor. You can do any other mathematical operator, something like square. And that would be the weightage. If you do in a square fashion, this is square root. Square is another stuff you can do. Things like that you can experiment with few mathematical operators like that. So your weighting changes. That's exactly what I have written here. So if it is the equal weight, just give 0.1. If it is inverse weight, do 1 divided by h2.
कल तो डॉक्टर की अपॉइंटमेंट लेके चले जाते क्योंकि कल चले जाते तो बोलो फॉलो अप को कुछ चार्जेस नहीं लगता 7 दिन का बना होगा फॉलो अप का चार्जेस लग गया हाँ 4:30 बजे तक ही रहोगा बट
Excuse me, I mean, sorry, who is that?
नहीं मैं बोल रहा हूँ 7 दिन हाँ मैं फ्राइडे ना रिलीज हो
Okay, this is whatever I have written here. This particular factor gets that value. Suppose if I have written inverse, so the weightage will become 1 by h1, h2. If I have written that in beta, it will become 1 divided by beta. If I have written inverse factor. So if I just do equal, it is 0.1, equal 0.1, equal 0.1, and equal 0.1. So these 4 factors, I'm just doing equal weightage. That means basically I'm investing 10 rupees in each of the stock. I'm not considering any factor weights. So in this particular fashion, my CAGR or the final value as of today becomes 352. You also can put Nifty graph here, Nifty returns, and then compare. For all the world is ending kind of news that comes out every time. In 15 years, we had only 2 bad years. 2014, that is 2015 year, just 5% down, which is normal. And if you can't bear 5% loss, then you can't bear any. I mean, you are not suitable for stock market investments. I don't know. Yesterday, somebody was asking, why do I always bullish? I'm bullish because I know I lose only in 1 year, or maybe max 2 years. That is over a period of 15 years. Now you have different permutation and combinations. So this is equal weight. We know that a beta has a reverse effect. So we'll change it to Higher the beta, lower the weightage, lower the beta, higher weightage. We will change it to inverse. So the returns jumped from some number to some number. We also know that giving weightage to correlation is underperformance. So I'll give reverse weightage. What I'm doing here is I'm multiplying all these factors at the end and I get one number, right? So that particular number I will sum and I will arrive at a weight. I also know that R2 has an inverse effect. So let me do inverse. So they jump to 540 now. And volatility is also, let's say, the inverse. They jump to 609. And this weightage I can give straight. That means as per market cap, because the top 10 market cap performs better. Okay, so it's reduced, maybe inverse. So like that, you fiddle with 5 combinations: equal weightage, inverse, square, root. If you have any fancy, you can write cuboid, cube, things like that. And then straight. Straight means it's the same weightage. You keep fiddling and you will arrive at some optimal combination. That's exactly what I publish at the start of the year. I lock it sometimes. I keep open most of my posts for a few days. Would have published in December. Yeah, I kept it open, so still. I haven't published in real time before 2018, so I can't claim the past returns. I can only claim from 2018 because from 2018 I'm putting this at some date in January 1st, first week of January. Because the file comes 2-3 days later, not exactly on the last date of the month. The weightage for this, the rank, sorry, the weights for this are I would have published, I would have hidden here because I don't want to reveal this particular stuff, how I am arriving. And So this is Hindustan Lever is with 73.67% this year. Yeah, so I've chosen invert for everything. What is the weight for ITC? 7.19, 7.2. LNT is 2.8. Yeah, LNT is 2.8. The next one is Nifty at 3%. Nifty at 3%. Yeah, so that's the weights. This is the weightage mechanism I've used. This is your 100 has become.
It is giving maximum weightage to one stock. Why is that so?
It has come like that.
Like
So
73%.
that is the criticism of this model. But my defense is if you look at Warren Buffett's portfolio, it is full of happiness. I think it's, I don't know what's the percentage of happy weight in Berkshire Hathaway. That's a downside of this model. So you can, we'll just see where it has gone. Berkshire weight, I would say 0.5, greater than 0.4. So it has done some quite a few years, 2011, 2013, 2017, and again in 18, and in 19 it has picked 2 stocks. 21 it has picked Hindustan Lever. The maximum it has picked is TCS at 83% weightage in that particular year, 2017. It is what it is. So what you can do is you can write a small formula, limit to 33%, and then rejig the portfolio. The rest of the 9 stocks with that 67% allocation. You can do that, but as I said, my defense is these are the stocks where you can't go wrong. If any of these top 10 market cap companies goes belly up for some reason, I'm sure government will try to rescue. If TCS is going down, like let's say 50%, and all other stocks are stable, hypothetical situation, I'm sure like government will try to do something to TCS. I mean, this top 10 companies employ almost 1 lakh plus employees, or more than that. So that's one thing which I think in the night. So when I go all in, which I went in the last 3 years, and that's when I started implementing this model also. So I started doing this kind of allocation from 2017 onwards. 2018, I had put an open this one. This is 2018. Yeah, so 31st December 18, somewhere it would be the post in real time. Real time in the sense telling before the fact, not after the fact. So, like this post I have written on Jan 1st of this year, somewhere in Jan 1st week. Yeah, Jan 5th. So now whatever returns I can claim, yes, I've told you in advance 8.4 versus Nifty flat. So this year this particular model is outperforming Nifty by small margin. Last year it underperformed. Nifty was 20% returns versus 13% returns for this model. COVID year, outperformed very drastically. Yeah, but you are getting the gist. So this is, you can also experiment with various weights. So fiddle and then see what's appropriate for you. So the only criticism in this model is this 82.75. That is the maximum weight in 1 year for one particular stock. All right. Any questions so far? Who has the comp? Hello.
I have it.
Who is
Rachit.
this?
Rachit here.
I'll give you about 10 minutes. Sorry, your name is something different, right? What's your name?
It's only Rachit.
Ah.
ONLY, only Rachit.
Okay.
What? Be that very clear.
What do you want?
Yeah, just download that and share your screen.
Cora, can you please upload that sheet with the change you showed in the morning from last week's webinar?
Yeah, I'll upload.
Okay, thanks.
Yeah, I replace that file. So
Thanks, Cora.
yeah, Rachit, what happened?
Is my screen visible?
Yes, you can enable editing. Go to the price data. Here, no, you have to update the 2021, 22 data. So download the total market cap.
Should I download the same report?
Where is it? No, not the report. That's the price data. Live market. The prices. Not here. Live index. Live market.
Live market
Index.
index.
And then download actually next 50, but some companies might have gone up or down. So download Nifty 500 or Nifty total market. You'll have all the stocks. Yeah, download Nifty 500.
This is Nifty total market. Should I download this or Nifty 500?
No, Nifty total market will have Nifty 500. So download CSV.
Okay. Yeah.
Now go to that price data file of Junior 50. Go where it starts, 31st 2022, December 22. Come down. Go up a little up. No, that's too much. Just where 2022 starts. Next 50 set. Find yeah. So get that stock list from 702 to 750. Go to your
Yeah, here it is.
VLOOKUP. Yeah.
VLOOKUP
in
this
the Nifty 100, Nifty 500, the Nifty total market cap.
Okay.
Paste it. Paste it on. And then do a VLOOKUP of those stocks. The price of today, which is December end.
I need to select it till LTP, right?
Yeah.
Column index will be 1, 2, 3, 4, 5, 6.
False. There is those names have changed. NMDC. Tell why they are not there. Get the manually NMDC price. It's not there. You have to go and search. Go and search in NSC. Uh, 123.3.
Where is the price?
Down 123.3.
Okay. Should I write it manually?
Yeah. Not here. In that we look up where you are doing.
Okay.
What is sell price? Can somebody tell?
Nineteen seventy
978. Okay.
Now get this data in. No. Only the data R column. Into notepad and paste it there. Into notepad and then paste it.
Paste it here.
Yeah, you have to go on top and paste it. You have to paste it exactly where it starts. 702. In E, you have to paste it. You have to paste it in E.
Sorry.
You have to paste in E702 onwards. Not there.
Okay.
Check any aberrations. Gland is down 30%. I know that. Now that one is 83% down. Jubilee Fit. So in the G you put 5. I think it's 1:5 split. Is it correct? 1:5 or 1:4?
Should I check it?
Yeah. Not circulars, just go back there and put.
One is to 5.
It will be in the corporate. Come down. I'll tell you. In that corporate information and corporate actions. Left side corporate actions. So 10:2. And the torrent former is 1:1, I think. Let's check. Not power, former.
One is to one.
Yeah, so you have to put 2 there.
5 here, and in torrent I need to put 1.
No, 2.
1 or
1:1, right? 2.
Yeah.
Land is correct. LTI is down 36%. Come down. Yeah, everything looks correct only. Now take the A, B, C, D, E, F into that factors.
whole.
Yeah. Via notepad because it's the formula. Go to that factor sheet. All right. So now we have the data. So write the headings for market cap in the J. Adjust the VLOOKUP in J2. That would be 8. Copy it across the board. Now do a sort. My data is headers. No. No, market cap large to small.
Okay.
Somehow here there's no outperformance for large cap. It is a small cap outperformance, right? The 12 versus 324. In the R 17 column.
Yes. That's
Point
312.
Yeah. Now what you do is you have to maintain in the sheet 3, just check what it is. Something like this. So just update Junior Nifty and you note it down. That you can do later. Now come to factors. Change it to market cap is 8, then beta.
Beta will be 9. This is not beta. Right. Yeah.
Sort.
Largest to smallest.
Yeah. In that case, top is left hand side and bottom is P. So that's why you have to sort top to bottom always. There is a stock length difference coming in here. Of course, this year lower beta is struggling in Junior 50. But still that's vast outperformance, 492 versus 260. Actually, low beta is not struggling. Just check the Junior Nifty value. What is Junior Nifty as of now? I've written 38,569. And R 20, write the actual value. You won't get there. You have to go to market data. Indices. $43,031. The second one.
This
43,031.
is Nifty next 50.
Yeah, that's the Junior 50 earlier.
Okay.
Yeah, Junior 50 is up 1.2%. Low beta is struggling because just check why. Come down. Because of Gland and Arrow Pharma.
And Oro Pharma.
Sorry, not Arrow Pharma, Lupin. Basically, it has gone into all pharma, and pharma is struggling. Gland and this one.
Yeah.
Ideally, Gland should be there because it's not a 1 year history. So you have to
This
pick
is
that.
like 4 pharma out of 10.
Yeah, but even if you remove Gland, Arrow Pharma will come. So that's another bad stuff. Okay, now do that for R2.
R2 will be 10.
Look at that massive outperformance.
So low
What are the
correlated
stocks?
stocks are doing well.
Yeah, what are the stocks this year? It picked up Gland. Actually, Gland shouldn't be there. Gland is not a 1 year old company as of 31 December 21. So that's a peculiar case. Somehow it is straight away gone into junior 50 immediately after listing. So if you remove Gland, probably Dauber will
We'll get
come.
Dabur.
Losses will come down a bit.
Losses will reduce.
You will do only average on F column. Select only F. Yeah.
Entire F.
Not entire F. F741 to F750. So it is 13%.
13.19.
Because Land shouldn't be there.
That is because of Adani Transmission is there with 116% return.
But it is what it is. Picked up, right?
Yeah. Yeah.
And then go to volatility.
Maybe 11.
Did you sort? Yeah, you
Yeah.
sorted. The same story, like what we found out for Nifty. The beta, low R2, low volatility outperforms their counterparts. Now go to price data.
Hmm.
Now go to price data.
Yeah.
Sorry, go to factors. Go to factors.
Yeah.
Go to factors. Change it
Yes,
to
I am
market.
into factor.
Change it to market cap. That would be 8. No. No. Small, large to small. Filter. Sorry. Go to R2. sorry, go to R2.
Yeah.
Select bottom 10. Filter. No, filter.
Yes.
Number filters less than or equal to 10.
Mhm. Yeah.
Get this A, B, C, D, E, F. Paste it in notepad and paste it in different weights.
Okay.
Now, remove the gland and replace with the 11th stone.
That is double.
I don't know, check. Unfilter and
That is Oro.
oh yeah, replace.
Okay.
Now go up. What we have taken is only the low R2 stocks, and you can fill there with the multiple options. Go on to L, put everything equal. So you are getting 760.
Mm-hmm.
So change R2 to in. R2 would be third item, N.
With
INV, inverse.
inward.
It is giving error because in one particular year, R2 of one stock is 0. There, no, that Lakhs of. Put 0.01 there. And highlight that, like you have changed it, right? That data point you highlight. No, 0.01. All right, now look at the performance.
We again have this 2018 as divided by this. There must be one more column there.
Check that.
One more.
That's again the same problem. GIC re was listed and immediately it went into the index. So they don't have the R2 data. So they just put 0.
Okay. So this is 648.
So that's not an improvement. So put it equal. See where you can improvise. Maybe the beta. Change it to. Let those be, no problem. Whatever changes you have done. No improvement. No, observe and then change. Don't blindly change.
Okay.
In the L, there's no improvement. So go back to equal or maybe change it to straight. ST. There's a massive improvement. And beta again, fiddle to straight or inverse. No, so go back to in. No, equal. And in the volatility, just check if you can get any improvement.
Not much of a change.
No, that's equal. You are doing no. Equal. In the N, it is equal. And fiddle in O.
If I'm changing, if I'm changing it with ST, I'm getting not much of a change there. That's what I'm saying.
In the O, I haven't changed.
No, in N only.
Yeah, N is done.
Okay.
Yeah, and maybe in both. Put in there.
No.
So ST is the highest. In
We
the
don't
N,
check with root.
they want. I mean, I haven't written that
There are
formula.
only three.
Yeah, you have to copy.
Equal, inverse, and ST.
You have to copy the
fine.
one from Junen.
Yeah.
And also change in the N. Is it straight or equal? Which is the highest?
Straight.
Yeah, the straight one. Yeah. So inverse.
No.
Okay. So that's your ideal combination in Winner 50 model. And in one particular year, you have gone 51% as a maximum weight. You might have to check because you can't take that kind of government will rescue kind of risk in junior 50 stocks because they are junior 50. Probably they would be employing 1,000 or 2,000 employees. So if they go down, I don't think government will bother. Even I won't bother.
So I should. I mean, we have
in
to change
that
it to
particular year,
probability of-
see if this year what is allocation. So that is a past history. You can't change it. This year history, what is it? This year, what are the weights?
for the current year.
Yeah.
These are the weights.
In R, just highlight R. Not majorly bothering because the highest weight is 25%
Yeah.
of
25.
Yeah, so at max
That
you
too
lose
for
20
Apollo Hospital.
at max you lose 25%. Right?
Yeah. We can keep this in a limit, right? Let's say I don't want any stock more than 20%. Any stock weightage of more than 20% or something like that.
You have to write a different formula. If the weight is more than 10, then you have to again adjust it to 0.2 and the rest you have to adjust.
Okay.
You can check
This
which
is
year it
for
has gone.
Nifty.
You can
Which
just check
year?
which is at 51% gone, where that weightage is 51%. No, you can't find that. Close. No, you won't find like that. Flow filter. And in the weight, you select greater than 0.4.
This was in 2016 for Divi's Lab.
Not majorly worrying, but yeah, so it is what it is.
These were the weights.
Yeah, so if 51% is bothering, you have to redo that. So just put it 0.2 and for the rest, you have to do it via 0.8.
So
You have to do it in
And through
separate.
here in separate file. Yeah.
Yeah, I mean, it's a little manual. You can't write a single formula, but you can attempt to write a single formula, but that's complex. Again, that's
Yeah. So if I'll do that, then marginally my returns will decrease. Not much, not more than that, because this 20% return, it will
that
be
can go
changed by
either
like
way.
what 60.
That can go either way. This year, if my Hindustan lever hasn't returned, then I will be underperform. So sometimes it goes in your favor, sometimes it goes against you.
It goes, yeah.
Because last year I was a victim for ITC. Last year, 13% returns, right? ITC had 30% weightage, and ITC didn't fire last year. And Hindustan Lever also had 30% weightage, and that didn't fire. So I underperformed last year. And this year, ITC performed massively, but I reduced my allocation to 8%, just 7%. Had I kept this 28%, but again, that your model doesn't allow. So the point that I'm trying to mention is, it will go either way. It's not like TV lab has given superior returns, so you have to reduce the returns. All right. So what I'll do is I'll just stop the recording for a while.